What is up, everyone? Welcome to Investing Club. In this video, we're going to talk about the S&P 500 and its current valuation and some evidence that shows that it is overvalued. And after that, I'll talk about what price I would personally start buying into the S&P 500. Now, I'm not a financial advisor and this is not financial advice, so always do your own research before investing into the stock market. So let's get into the current valuation. This is a chart I've showed in past videos. It's the Shiller PE ratio, and this is simply the price divided by the earnings of the S&P 500. And right now you can see it's at an extreme high that we've only seen a couple of times in history. One was right before the Great Depression, and another one was the dot-com bubble of the 2000s. And right now, those are the only 2 points in history that are higher than where we are right now. To compare that to where the usual PE ratio is, the mean and the median are both around 16. So right now we're almost double what the normal PE ratio is. And so a quick way to determine the fair value of an index like the S&P 500 is just to take their average PE ratio. Obviously that doesn't account into a lot of things, but just based on that quick valuation method, then that's probably when I would be interested in buying the S&P 500 if it was at a PE ratio of under 16, which isn't likely to happen for a while. That would be almost a 50% drop. So will we see that happen? Perhaps, but we'll have to wait and see. Another thing I want to point out is the S&P 500 price to sales ratio is at almost an all-time high. It's above 2, and this chart doesn't go back that far, but historically, whenever it's been above 2, it signals that the market's very overvalued and we are likely to see a crash in the stock market at some point. And a big reason that the stock market's still going up is just because of the concentration of the largest stocks in the index. In a past video, I covered stocks like Facebook, Apple, Amazon, Google, Microsoft make up a huge portion of the S&P 500. Right here, 5 companies now make up over a fifth of the S&P 500, and that has only happened a couple of times in history. It usually signals that money is being concentrated in these very few stocks and that they're likely overvalued. So I've talked about all these things before, so now let's talk about something different and think about a different way to look at the valuation right now. Someone I follow a lot is John Hussman. He is an economist that runs a number of funds, and he does a lot of work with stock market valuation. And what he does specifically is uses mathematical data to predict the future return of an index like the S&P 500 over a period of time. So for example, over the next 10 years, what the return will be. And so right now from this chart, the red line is the S&P 500, and what you can see is over the next 10 years, the expected returns from John Hussman are expected to be negative for the S&P 500. So that means over the next 10 years, the stock market, according to him, is not going to go anywhere and will go slightly down. And so I think that's definitely a different way and an important way to look at things, because I've talked a lot about how the stock market's overvalued. But the thing is, that doesn't really mean anything in the short term. There's always been times where the stock market's overvalued, but it just keeps going up. And the perfect example of this was in the dot-com bubble right around 1996, 1997. A lot of people were starting to say the market was overvalued, including Warren Buffett. And after that, the stock market just kept going up for another 4 to 5 years before the bubble finally burst. And so instead of just saying the stock market's overvalued and we're going to see a crash soon, which doesn't really help anyone, I think it's more helpful to take a look at what the expected returns over a long period of time will be. Because over the next couple of years, anything could happen. Stocks could keep going up. But if you take a look at a longer time frame, that is when you'll really see a higher probability of stocks return to normal valuations. All right, 10 years is enough for a full market cycle at least. And so over the next 10 years, we are likely to see stocks go to their historical valuation. And according to John Hussman, over the next 10 years, that will mean that we'll see a negative return in the S&P 500. And so the important thing to note about this chart is that these projected returns are the lowest ever. If you use this data in 1928 and 1929, the expected returns were higher than this, and we saw the Great Depression. And in the dot-com bubble, they were also higher than this. So over the next 10 years, things are expected to be the worst, ever, at least in the last 100 years in the history of the stock market, according to John Hussman. I'll put a link down to his blog if you want to read it. It's pretty interesting, and he has a lot of interesting information in there. So if you want to learn more about this, obviously this chart factors in a lot of things that I didn't cover, so I'll put it down in the description if you want to take a read. Another metric that he likes to look at is the margin adjusted PE ratio. So essentially, this is just the PE ratio, and you also account for profit margin. And here's the chart, and you can see we're pretty much at an all-time high, similar to 1929 and the 2000 dot-com bubble. And obviously we haven't seen a stock market crash yet. We saw one in March, but we've rebounded pretty quickly. And a lot of people are saying that was it. That was the scare, and now we're going back up and we're starting a new bull market. And John Hussman compares this period to a lot of periods in history right before a recession that we sort of see this, he calls it an incubation phase. And that's the phase where we see some panic initially, and then everything cools off for a while and people breathe a sigh of relief and start saying, all right, that was it, everything's all right now. And then once everyone's calm, the floor drops out, and that's when we see the majority of the damage in the stock market. So an example of this is in early 2008, right before the Great Recession, AIG, which was the insurance company that went under, that's when they first announced that they weren't sure what their losses were going to be. And after that, everything went downhill. So that's just something to keep in mind, that these events take time to fully go through. Probably not smart to think this is over just because we've seen the stock market go back up for a couple of months. All right, and now we are on fast graphs, and this is a chart of the S&P 500 compared to the orange line, which is a 15 PE ratio, and what has been the average PE ratio since around 2000, 2001, which is a little higher at 17.5. And I like to do this sometimes. I like to take a look visually at where we are on the chart to see what future returns are expected to be. And so this is an exercise I like to do a lot, and it's pretty simple. All you have to do is take a look at the price in relation to the valuation and see what happens to the price. I've done this in a past video, and wherever the S&P 500 is above the blue line, it is clearly overvalued, and I would expect it to go down. So we can take a look back in 2001, it was clearly above the blue line, and what you can see is from 2001 all the way to probably around 2012, 2013, the stock market went sideways. It did absolutely nothing. And so that's the danger of investing when stocks are overvalued like they are right now. You would probably get better returns putting your money in a bank account, even if it's still losing money to inflation. And on the flip side of that, look what happened when stocks were undervalued, when they were under a 15 PE ratio, which we haven't seen for a very long time, this whole period. And after that, we saw the huge bull run that stocks went on. And so investing during that time would have been a very good decision. So all you have to do is take a look at where we are now. And we are above the blue line. And like I showed at the beginning of this video, we're a PE ratio of 28. That's almost double the normal PE ratio of around 15 or 16 for the S&P 500. And so would I be investing here? I would definitely not be investing in the S&P 500 at these prices. Again, just my opinion. Even if I was dollar cost averaging, to me it just doesn't make sense to be buying in at these high valuations. Of course, it could keep going higher, but eventually mean reversion will get to the stock market and we will see a return back to its normal valuation at some point. I don't know when that's going to be, but I think it will happen. And so I made a video a number of months ago, probably back in December or January, right when we were up here, and I said, look, I wouldn't buy the S&P 500 right now, it looks overvalued. And in the comments, I got a lot of people claiming I was trying to time the market, and I disagree. I don't think this is timing the market at all. All I'm doing is looking at valuations and determining if I should expect a good return over the next 10 years based on the price today. And there I thought, no, definitely not. And even now, I still think no, even though we had a huge drop, even at the lows that we saw in March, it's probably not a price that I would start buying into the S&P 500. So that begs the question, at what price would I start buying the S&P 500? And I said this at the beginning of the video, when it reaches its normal valuation, that's a quick, fast way to determine the intrinsic value of the S&P 500 when it's trading at its normal PE ratio, which is around 15 to 16. And so right now for 2020, that is expected to be around 1,887. So that would put the SPY at around $188, which is a very far drop from where we are now. And so those earnings estimates are for this year, where we're going to see a drop in earnings. Obviously, they are expected to rebound pretty quickly, even though I'm not sure how much I believe in those estimates. I think it's still very unclear at this time. But I think the most I would pay for the S&P 500 right now is where the earnings are expected to be next year. And that is around 24.34. So that would put the S&P 500 at around $243. That's probably where I would feel comfortable buying the S&P 500. Now that being said, I probably wouldn't buy it anyway because I mainly focus on individual stocks. But if you are an index fund investor, that's just my thought. That's my take on where it would make sense from a future return perspective to buy the S&P 500. And it's important to note that we didn't even get that low in March. We got to around 2,500. So we were still above that level of where I would consider the S&P 500 to be fairly valued. And that's part of the reason I think eventually we're going to go lower than that. Again, we'll see. I don't know how long it's going to take. It might take a couple months, it might take a couple years, and in that time anything could happen. We can easily see stocks keep going up. So again, this is just my opinion on what I think will happen eventually. So that's it for this video. So let me know what you think. Leave a comment down below. Do you think we'll ever get to 2,500 on the S&P 500, or do you think we've started a new bull market and we're going to keep going up from here? I'd love to hear what you think. And if you learned something from this video, hit the like button, subscribe to the channel if you haven't already, and I will see you on the next video.